In this section of the discussion on financial leverage, I present a case analysis that helps us determine when the use of a more levered means of financing is desirable. The case is entitled Abgeous Construction Company. Now, before continuing to watch this presentation, please take a moment and read over the case, which is also shown here. And here's the case summary. The company's current annual revenue is $10 million. Variable cost as a percent of sales is 60%, and so total variable cost would be $6 million. Fixed operating cost is $1.2 million. The company currently has debt outstanding to the tune of $2 million, carrying an interest rate of 12% per year. Corporate tax rate is 25%. Number of shares outstanding is 150,000. Dividend payout ratio is 40%, so that every $1 of net earnings, for every $1 of net earnings, 40 cents goes to pay dividends, 60 cents are reinvested back into the firm. Current stock price is $20. Alright, so here's the deal. The company has a planned investment of $5 million. And this is expected to boost revenues by 75 million bucks. And so if you go back here, if we go back here, current revenue is 10 million. If we boost this by 75%, that's going to catch us up to $17.5 million. Variable cost as a percent of sales will remain at 60%, and so 60% of 17.5 would be $10.5 million. Fixed operating costs, though, are expected to rise from, I go back here, 1.2 million to, going forward, 1.3 million bucks. So now the issue at hand is a financing decision. Now, how do we raise the $5 million to make this investment? One plan, which is a more levered plan, we're going to call it a debt plan, calls for a debt ratio of 80%, meaning that we're going to have to borrow 80% of this money, which comes out to be $4 million, and the remaining $1 million will come in the form of equity. This additional debt will carry an interest rate of 14%. Now the remaining $1 million would have to be raised in the form of equity, and given that, I go back here, the price per share right now is $20, we find going forward that the total number of shares that would have to be sold in order to generate $1 million in equity would have to be $50,000, sorry, 50,000 shares, meaning $1 million divided by $20 per share will give us 50,000 shares. Now the equity plan calls for borrowing only half of the money, so that $2.5 million will be borrowed and the remaining $2.5 million will be raised in the form of equity. Now the amount borrowed would still cost 14%. Now for us to raise $2.5 million in equity at $20 per share, that's going to come up to 125 shares that will have to be sold in addition to what the firm currently has. So now let's go to spreadsheet and look at the financial analysis. Here we go. Now we've already looked at the current situation of the firm, and we also have looked at the proposed situation and the two financing alternatives. Alright, so now here is the analysis. Currently though, the firm's revenues are 10 million bucks. Total variable cost is 6 million. Fixed operating cost 1.2 million. So subtracting these two costs, we have $2.8 million in operating income, which is earnings before interest and taxes. And so we're going to subtract interest expenses, which if I go up here to the input, it's going to be equal to the interest rate of 12% multiplied by $2 million in debt outstanding. So going back down here, you find that that's precisely how I calculated this amount. If you look up here, the multiplication of those two cells. And then we're going to subtract, we're going to have to account for the tax effects. And the best way to account for tax effect is not to use the equality syntax, but to use the negative sign. In other words, we're gonna do negative, and then we're gonna go up here to the input and click on the tax rate cell. And if we look up here, you'll see what I'm doing. Multiplied the asterisk sign, and I'm going to scroll back down here, multiplied by this earnings before tax, and hit enter. That way, if your earnings before tax is a positive number, your tax effects would report a negative result, meaning you're going to have to pay this tax. If on the other hand this amount here were to be a negative number, let's just play with it. All right, put in a negative value, right, sign there. All right, then this automatically becomes a positive number, which of course means that the firm would enjoy tax savings since earnings before tax is a negative. All right, so that's a good way to make that cell global. So I hit undo. So now here's our net income. Current number of shares is 150,000. So dividing 150,000 into 1.92 million, we find earnings per share of $12.8. We can calculate degree of operating leverage, which measures the percentage change in EBIT as a result of a given change in revenues. That comes out to be 1.43. Right here, I remind you of the formula, which is sales minus variable cost divided by sales minus variable cost minus fixed cost. Notice the denominator is earnings before interest and taxes. Now then, degree of financial leverage can also be easily calculated. Degree of financial leverage measures the percentage change in net income as a result of a given change in EBIT, in earnings before interest and taxes. So I remind you of the calculation formula right here, which the numerator is sales minus variable cost minus fixed cost, which actually is EBIT, and then we divide that by sales minus variable cost minus fixed cost minus interest charges, which is actually EBT. All right, and then total degree of total leverage is actually the product of these two numbers right here, and that's what I show you right there. Degree of total leverage measures the percentage change in net income, the bottom line, as a result of a given change in revenues, the top line. All right, so now the break-even point based on current condition for this firm is $3 million. The break-even point here in dollars would be the level of sales at which EBIT is 0. So let's show how that's done. We're going to have to go to data and go to what if and choose goal seek. And we want this cell here for EBIT, click on it, to have a value of 0, and click here. By changing, what are we going to be changing? Go up here, let's change revenues. So what would be our revenues so that EBIT would be 0? I answer 3 million. So if you go back down here, you see that in fact our EBIT is 0. So that level of revenue is $3 million, which I've written out right here. So I'm going to click undo. So now let's go to the main action, which is what would be the situation given this new $5 million investment, whether we use the debt plan or the equity plan. Revenue is projected to be 17.5 million. Variable cost is projected to be 60% of revenues, which would be $10.5 million. However, fixed operating costs would rise from currently $1.2 million to $1.3 million either way. Changes come when it comes to interest expenses. And as you can see here, using the debt plan, our interest expenses would rise from $240,000 to $800,000. How did we get this number? Well, delete. It's equal to the current interest that's being paid on the current amount of debt plus, we open parenthesis, the interest that will be paid on the new debts, which would be 14%. You can see my calculation up here, multiplied, all right, by $4 million, and then we close parenthesis and hit enter. And that's how we get this $800,000. For the equity plan, it's going to be the same thing. It's going to be equal to the current debt. Well, let's do this correctly. Equal to the current debt plus, we open parenthesis and then we go up here a little bit, 14% interest rate multiplied, you can look at what I'm doing up here, multiplied by $2.5 million. And that's it. And that's how we get this 590,000. So now with all of those factored in and calculating out the tax effects, we find the net income and number of shares outstanding with the debt plan would be the existing number of shares of 150,000 plus the additional number of shares, if I scroll up here, of 50,000. And for the equity plan, it's going to be the existing number of shares of 150,000 plus $125,000 of additional shares. That's going to catch us up to 275,000 bucks. Earnings per share would be simply net income divided by number of shares. That's it. And ditto over here. And you can see that the debt plan has the greater earnings per share than the equity plan. EPS under the debt plan is $4.44 higher. So all I did here was to go equal this amount minus this amount to show the difference. All right. So a good question to ask is, what would be the level of sales at which these two numbers are the same? That's called the EPS indifference level for sales. So now let's show how that's accomplished. All right. Now I've already calculated it out, and we see here it's going to be $6.65 million. So I'm going to use the what if command. All right. Just come out right here and hit and go to what if, goal seek. Now we want this difference here to be 0 because that means the two numbers here would be the same. And that's going to be accomplished by changing, go up here, click right here under the proposed plan. All right, OK and OK. That's it. That's the 6.65 million. And indeed, if we go down here, you find that the two plans now have the same earnings per share at a sales level of 6.65 million bucks. You ask, well, what's the big deal? It's an important big deal, actually, because if in this investment, in this planned investment, if we reckon that the firm can expect to earn over $6.65 million, then the firm should choose the debt plan because the debt plan will give a greater earnings per share. If on the other hand we reckon that the firm will have sales of less than $6.65 million, then the equity plan is going to produce the greater earnings per share. So it all depends on our revenue projection. Revenue projections in excess of the indifference level suggests that we should go for the more levered plan. Otherwise, we go for the less levered plan. So let's assume that the firm expects revenue of $6,500,000, for example. That's 6.5 million. So we come out here, $6.5 million. So if I scroll down here, you see that in fact the equity plan has the greater earnings per share by 6 cents. Now if on the other hand, let's undo, we're expecting a revenue of, let's take a number more than this, let's say $7.2 million. So go up here and let's change this to 7,200,000. All right, and you go down here, you find that in fact EPS under the debt plan is greater than EPS under the equity plan by 23 cents. So as you can see, the indifference level gives us an important insight as to which financing alternative would produce the greater earnings per share, being mindful of the additional risk associated with the use of financial leverage. So that in this original example, you find that projected revenue is a whopping $17.5 million, which is, as you can see, far greater than the indifference level of 6.65 million. No wonder this EPS is greater than the EPS under the equity plan. Now, in the same way, we can individually find what the sales level would be that will cause this earnings per share to be zero, or in the case of equity plan, what the sales level would be that will cause this EPS to be zero. So for example, if we choose the debt plan, the question is, what would be the sales level at which EPS is zero? So again, it's a what if situation here. Goal seek. All right, let's make this EPS 0, and then click here by changing. What do we want to change? This, the revenues. Okay and okay, and that's 5.25 million. If you go down here, that's 0 right there. In the same way, you can find what it'll be, what the sales would be that will cause EPS under the equity plan to be 0. So I've undone everything. Now finally, observe that we can also find by how much EBIT would fall if revenues are expected to fall by a certain percentage. Say for example 10%. If it's 10%, if revenues are expected to fall by 10%, then EBIT would fall by 12.28% under the debt plan as well as under the equity plan. Of course, this is an argument under degree of operating leverage, which looks at how EBIT, the middle arguments, would change when the top line changes, the top line being revenues. Now the second issue here is by how much net income and earnings per share would fall if EBIT were to fall by a certain percentage. In this case, 10%. If it does, then we find that net income would fall by 11.63% under the debt plan, which is an argument under degree of financial leverage, as I remind you right here, which looks at, if I scroll back up here, how the bottom line would change, all right, for any given change in the middle line, operating income. So, and of course, to get this number, all you would have to do is you multiply this 10% by the degree of financial leverage of 1.16, or this 10% by the corresponding degree of financial leverage here, which is 1.12. And you can see quite clearly that a drop in operating income would bring about a larger change, negative change, on the firm's net income if it chooses the debt plan than would be the case if it were to choose the equity plan, simply because this plan here is more levered. Now finally, going back here to the spreadsheet, we want to be mindful of the fact that we can also manually calculate the indifference level, which is the level at which EPS is the same under equity and debt options, and I show it here. The numerator here is actually net income, sales minus variable cost minus fixed cost minus interest expenses expressed on an after-tax basis divided by the number of shares under the debt plan, and ditto under the equity plan. So all we have to do is to substitute in the values and solve for S. And of course, we can do this easily algebraically by cross multiplying and solving for sales, which is going to come up to be $6.65 million. So this concludes this presentation, which shows how a prudent financing decision can be made when a firm is seeking to determine which financing alternative would give it a little bit more bang for its buck, based on all the financial estimates that the firm has on hand. This is Pat Opie, Professor of Finance, Purdue University, Calumet.